If you ask any professional trader out there a chart they've been watching recently, they're all going to mention oil. And why wouldn't they? It predicted that US yields were going to rise. But with a massive crash happening in the last 24 hours, it's time to talk about it once again. We also need to talk about jobs numbers. We've just seen a huge reaction on the market, and it puts even more emphasis on what's going to happen this Friday. But really, it's not just about that. It's about dark pool transactions coming through and some super sneaky stuff coming in from the Federal Reserve. Did they just inject a whole bunch of liquidity back into the market to possibly cover for something that broke? Remember, on the channel, we've talked a lot about when we see yields go into this fear of the unknown, something in the system's often breaking. Well, with oil crashing the way it has been, and of course puts going out of control in the last 24 hours, there's a lot to discuss. Join us as we cover stocks, commodities, and cryptos together. Well, welcome back everybody to the daily show where we discuss the macro lead indicators and the hottest charts. What a 24 hours we just saw. Markets went down to 4,200, basically kissing the point that we thought was one of the biggest areas in the markets. And of course, then we saw that inevitable rebound. Will we get any lower? Well, today we'll make the case for both bulls and bears moving forward. What was more interesting though was all of these tech stocks. They were going ballistic while energy was just absolutely getting crunched. We also saw metals selling off, and it was overall a huge switch in momentum for the day traders and of course the market internals. So what do we like about the market and what do we hate right now? Well, the first thing is you've got to love the fact that stocks are so heavily sold. Only 7% of the S&P 500 stocks are trading above their 50-day moving average. Now, this will have changed as of today, but this is an incredible read. Now, I've got a little bit different read, but still very damn low. And this is something that I think is super important. Every time we've seen this over the last couple of years, it's marked close to the lows in markets. I also want to mention gold again before we get into the rest. And the reason why I want to do this is because gold is so heavily traded to the downside in comparison to even spot price. So gold stock here, you can see the average versus where we are right now. Now, this may just be changing. The reason why I say that is because we got close to 1910 on the spot, but also we saw some large trades starting to come back into gold, which is very interesting considering where yields just potentially peaked at. Fear and greed index, we always know that this is a good reader. As Warren Buffett often says, when others are fearful, you need to potentially be greedy. Well, we did end up getting a 16 to 17 read over the last 24 hours, and now we're sitting at 19. So we're seeing a little bit of an uptick in the fear and greed index. But this is probably the one that we're looking at the most closely. Remember March? Well, we just hit the level. So basically, bullish percent index has reached the same kind of sell-off that we saw in March from the chart perspective. Could it get worse? Of course, anything can always get worse, but it's something we will be watching very closely, and we're looking at this indicator as it helped us to really define, of course, the sell-off in August and the false rallies that we saw past that point. Another little reminder that utilities, although there's only 4 reads from it, are at a very interesting level. Of course, it's capitulation on utilities. They continue to look quite weak, but there are some interesting stats and stats only to go off from this point. But with only 3 reads, you need to take it into consideration. Let's move over to what happens in pre-election years. Well, if we go back over all of the last 1950 pretty much to 2020, and we think about pre-election years and normal years, you'll notice that there's a little bit of a difference. In fact, pre-election years tend to actually have this kind of rally at the start of the month, sometimes a little bit of a dip at the end of the month into a rally for November and December. In normal years, we tend to actually just see mostly a rally throughout the rest of October. And I can tell you that there are some very strong stocks that do come out in October. Notably, Apple is one of them, and that's been sold pretty heavily recently. 1985 versus 2023, a discussion point we mentioned before. It's really the closest year that we have that marks the same as 2023. A super strong front end, followed by August and September being negative. And then, of course, October, November, December tended to be very strong. I don't think it's going to be 16%, but what I do think is that statistically, most of these types of years that started so well do tend to end okay. And remember, people that are thinking a recession that's coming very close or very soon, we tend not to see a recession until yields actually uninvert and go against each other. Let's get over to some of this dark pool transaction stuff though, because there were some big trades coming through. First up, gold. Yes, we did see a large trade coming in, No, we don't know whether it's a sell or a buy, but you can kind of assume that somebody believes there's some value in it now because they are most likely accumulating position. Price action will now need to be watched on that. We also at the same time saw something very interesting indeed, a dark pool transaction or cluster of transactions that came through, and it happened at the same point that we saw in March. So we saw a sell-off in March, then we saw a huge trade, and obviously over the last 24 hours, we also saw a huge trade as we came into that 4,200 zone on the futures. So basically, somebody thinks there's something going on here. Is that a sell? Seems unlikely, and I'll show you why. And it has to do with the way the clustering was. They basically went all day, and it was pretty consistent. By the end of the close, we closed to a new high, which usually marks a little bit of strength. But this was a very interesting thing, and of course we need to watch this now over the next coming weeks and days. So let's now take a look at the market, and more importantly, what's going on with some of the options activity. We mentioned the fact that put-call ratios were getting wild, but have a look at the iShares Russell 2000. It was 2.57 times the 90-day average, but look at these puts, almost 2 million in comparison to 500, and that's what we have at the time of this recording. It may even be more than this reading indeed. Over on the S&P 500, we have a 1.12 times, again, puts getting stacked, the same thing on the Qs, and then it was just the same across the board. Look at the gold shares, 501,000 puts, 4.31 times the average volume. And it just kept going on and on and on and on throughout pretty much all of these major stocks. When we scroll down, we have a look at another interesting component. It was clear that people were going negative. 56% puts versus 44% calls, with an average of 40 million, which is above the standard daily range. Something that's definitely changing here in the market. It's moved from a buy the dip market to sell the rip. At least that's what everybody's trying to do. Are they right? Well, time will tell. Let's have a look at the last 5 days of trade. Now, this is where, again, we're seeing semiconductors, technology, consumer discretionary, and of course, communications do the best. In a market that's generally been selling over this period, you wouldn't expect those stocks to do that well. You'd usually expect more of the defensive stocks to do well. What's been doing poorly? Utilities, energy, clean energy, solar, metals, the stocks that you'd usually expect to be doing well, yeah? So this is a very big change, and it's the same thing over the last 24 hours of trade. You can see consumer discretionary, semiconductors, all of these stocks were doing better. What a strange coincidence that happened at the same time that, remember, tech stocks were unable to make those new lows, and Tesla, my goodness, 5% over the day. So let's take a look at some of our other reads here. Percentage of stocks above 20-day moving average is now sitting at about 18.6, again consistent with kind of getting to those oversold characteristics. And we've talked about the percentage of stocks above the 200-day moving average, which sits at 32.58. So another interesting read. Have a look at this PCC. I almost think it's fake. But yeah, PCC showing a 1.639 read. That's massive. And that kind of points towards, again, too many puts in the system. I'll verify this later on. But because I'm recording this so close to the end of the session, I have taken that into consideration. Of course, I would weight it a lot less because it's just such a weird read that we're getting through there. Here's where things get a little bit better for market bulls as well. We saw the US 30-year put in a pretty large looking top. And when we go to the US 20-year as well, you can see here that we get another huge rejection. Now, this changes quite a lot because, again, markets are just seeing these kind of shooting star style rejections from almost all the yields, and it looked like they wouldn't stop. Of course, the pain trade was higher over these sessions. US 2-year as well has remained relatively stable, and what most recession callers are going to be looking for now is, of course, to see these uninvert, because only after usually we see an uninversion, which look at that, look how it's coming in here, do we usually get some form of recession called. Now, there are some stats to go with recession, so make sure to subscribe. We'll talk about that should we actually start to see this thing get underneath. But I think it's inevitable now that we're going to see uninversion of the yield after being above for the biggest period of time ever. So many people are going to be looking at this going, well, I'm just super confused. Let's get into some further price action. First up, the MOVE index. Bond volatility dropped relatively quite a lot actually over this 24 hours. So we saw it really spike back up. And again, when we've seen similar drops to this, it's often marked the lows or temp lows for that market. The VIX also dropped out, and the volatility of the volatility, which is the VVIX, that was also dropping out as well. So again, some big changes here. Treasuries did post a little bit better. Again, it's not really that much of a reprieve just yet, and they're in the middle of nowhere. So it's going to be hard to say that treasuries have seen the lows yet. Of course, yields really is the main discussion here, but treasuries finding some kind of buying pressure over the last 24 hours. Let's have a look at home builders. Are we out of the horror show yet? Well, not really. We'll probably know more of that at around 78. So home builders still one we're watching, and we won't really know that we're past the worst yet until they start to recover. Have they done so? Well, it's only one day, so of course not enough from that perspective. The US dollar, has that broken down? Not really. It has shorted off on smaller time frames that we'll look at very soon, and it's happening at the right zone. But the biggest thing here is, of course, going to be that 20 moving average. We've seen this before, where the US dollar weakens, it hits that 20 moving average, and what a beast it's been. It's absolutely just seen buying every single time it's hit that level. If it breaches underneath, I think swing traders will feel more confident in a sell at that point. If we take a look at what's happening on the US dollar, it does have a temporary turn in it, which actually already gave an excellent sell that I talked about in our private community. But this was probably a pretty good session for a lot of currency traders. Things like pound as well were doing pretty well, and you actually had some replication through here for some trades to go against the US dollar for the first time in a while. If we do see a rally, I expect it to kind of be back into this zone, somewhere around 106.80, and then possibly some sell-off from that perspective. As we mentioned with gold, it's coming into that heavy demand zone of around that 1810 all the way to around 1820, and we're looking to see whether we see some structure here. Somebody's already betting on it, you would think, based on that large gold trade, but there's not enough here to go off from a technical base level. Do remember that these bigger traders, they don't trade like you or I. They don't have stop losses. They don't really care about necessarily a few weeks. They position in and they increase their book as the profit goes in as well. Sometimes they even increase as it's going down, as long as that is in their system. So remember, they're more positional trading, not necessarily the way you think. With oil, did we expect this fall? Well, yeah, I guess we expected the fall, but I would have liked it to be up here, so we could have shorted it. 91.50 was our target towards the short, where we saw supply, and it didn't want to get there. It just kind of sold off way before that. And while, oil may recover a little bit, I think this is a monumental shift for oil traders. This is a huge sell-off back down to these previous levels of resistance where it could become support. And more importantly, I think it really marks things like 89 now being a huge level should the markets come back to. I expect sellers in here and here, and maybe this is the low or the high for oil. What do you think in terms of your analysis? Is this the highest point we're going to see for oil this year? Maybe we'll put a poll out on our X account and of course on our YouTube account as well, so you guys can see what everybody's thinking out there with oil. Let's move over to Microsoft and the other tech stocks. So before we go into Tesla, I think Microsoft and these other tech stocks did tell us something. Remember, semiconductors weren't able to make a new low while the market's making a new low. The strongest, best sector in the market, Microsoft did the same thing. Let me load semis just so you can see what I mean here. And this kind of gave us a little bit of an inkling. If you remember back over the last 24 hours, we were saying, well, the thing that doesn't make much sense is the market made a new low. It looks like capitulation was coming through, and it was for that session, but we didn't see the strongest part of the market actually doing that, showing us that the internals of those particular companies was actually looking a lot better. Here's what semiconductors did, but it was just the same across the board. Whether you look at something like Meta, which was already holding a lot better, or you look at something like Apple, which was doing pretty similar thing, you're always going to get a very similar read. But where Tesla was the best, it was the best. It really held up, and it just came out with a monster gap open and then just rallied through the rest of the session, almost posting 6% over the day. Now, bears are going to be going, well, what about this gap fill? We're so close now. I'm going to try shorting Tesla. Yeah, I guess you could try that, but you're probably not going to see that price action just yet. So you'll notice that, of course, we're going into what you would call the golden pocket. That's a huge TP level for a lot of day traders and scalpers and stuff, but you're going to need more structure here to really say that that's a definitive short. At this stage, Tesla's looking pretty damn good on the charts. And when you look at weeklies as well, there's a lot to like about the fact that it put in this doji if it manages to hold up here. So a lot of this is going to come down to these jobs numbers on Friday. If they hold markets in certain positions, then you would be able to say that there's a strong buy presence in the markets at this price. What about regional banks? Well, regional banks took the low, so big level there, came back into this demand zone, and they did find some buyers as well. So regional banks also showing us here that the two dojis were cracked and closed above. Yeah, it's a positive sign. It's not really enough yet to really say it's turned around. German 40, this is something we had 14,000 kind of 800, 14,900 on our targets. It reached 14,940 in the futures and then rebounded in a big way. So another one of these markets that got down to key levels, but I think it was the S&P 500. Once that hit that 4,200, wow, everything just bounced and bounced and bounced. I'll just show you quickly here what I mean by that. There's 4,200, which of course we know is a big key zone, and it hit it and just went boom. Every single algorithm you could think of probably just went, yeah, I'm going to buy that. Thank you very much. It doesn't mean the end of the selling is over, but it certainly does show you some decent rally. And we'll look at that structure in just a moment. The Aussie market, the ASX 200, well, that's doing the same thing. Basically, it's bouncing off. And it's bouncing off that weekly 200 moving average as well, which is a pretty key moving average. If you go through a lot of history, sometimes it does act quite nicely on these charts. The key to the Aussie market is going to be realistically the first thing, which is 7,100. And also 69.80. I don't think it's necessarily out of the problems because of the energy and metals markets finding some weakness here. But yeah, a little bit of a positive sign there for it. Let's move over to the big ones though. Let's go to the US markets. The Russell 2000. I'm looking for a big print here. I want to see some type of large trader really get involved in the Russell. The reason why I want to say that is because when we've seen similar things over in these previous history points, they've been very positive for the markets, and we didn't see it over the last 24 hours at least with the current reads. So could this be the low? Well, of course, everyone sees it as support. It's a critical level. A lot of people will have already had a go at this at around 1735-ish, and I wouldn't blame them, but it's a relatively positive sign. This is another one that I'm looking at. Look at these Qs. So the NASDAQ 100, if it closed like this would put in a tweezer. Historically, a pretty strong signal. We've seen a couple of double rejection wicks before, but here is the double strength wicks, and of course we've had those over here as well, have them over here. You can kind of see these wicks really do hold sometimes the key. If the market was to close this way and then breach past that high, that would be a pretty strong sign for markets. They'd also hold the weekly 20, which is often considered mean reversion. So the tech stocks are looking good. For bears, you will absolutely want to see a close below this low. If you're getting a close underneath 14,400, it's going to be super significant, and I think you're going to have a lot of fun because markets are probably going to go super volatile if that does occur, especially on the NASDAQ. Maybe something to worthwhile setting alerts for in the future. Let's move over to the S&P 500. I want to use the real market here just to kind of show the difference. So it closed close to its high. Obviously, we see the wicks down here. Didn't quite hit that 200 moving average on the real market during the session. It obviously did it during the futures. And you can see we're back at that 2 hour 20 moving average. So, kind of a zone where you could see a little bit of weakness come back in. But let's move to the futures here and understand the smaller price action. Now, in our community, I was mentioning this in the open. I said, there's a very good chance that we were going to get two kind of scenarios. And one of the scenarios was that we would make a new high straight after or around that news kind of release. Now, the ADP jobs numbers came out and they looked a little weak. And of course, the market liked that very much. So we ended up getting that high steal, and then we saw the markets come back down. They actually came back down to a 61.8 fib. And around this level, we saw a lot of buyers start to process into their market. And that is a pretty good sign that we were about to go longer. And of course, you can see the volumes that we're transacting through here. Plenty of buyers and plenty of sellers. So let's talk now about where we are in terms of the key levels. And the first thing I think is that we've come back to, of course, where you often would see sellers. Why? Because we've got that support, resistance, kind of role reversal combo. The biggest thing here, though, for bears is going to be actually able to get underneath this. So you notice how we've actually placed a little trend line here as we've been buying up. You've actually got an ascending channel that's coming through, or at least that's what we're seeing on the picture here. So first up, we know there's sellers because there's been sellers around this level. For the bulls to really gain control of this market, they're going to want to push past some key levels we'll discuss in a moment. But for the sellers, it's going to be 42.29. They're going to want to get underneath that price, possibly even push 42.20, and then you might see some rallies into some sells. This will be the critical fight zone between the next 24 hours realistically. If we go to the daily time frame and we reset that, what we're looking for here is a little bit different. We actually want bulls to push all the way back up above 43.30, 43.40. Now, if that does happen, I'd say that we've just seen the low and that the markets are going to go more than likely to new highs. Somewhere in here is going to be the key level between the real bulls and the bears fighting it out. So it's not out of the problems yet, but it was a pretty strong recovery over the last 24 hours. Bullish percent index, we'll watch that. We'll watch many other things. And those puts, wow, there were puts everywhere. So we'll have to find out and get to the bottom of that one as well. Let's move over to Bitcoin, which continues just kind of, move higher slowly over time. Basically, it sold off and it found a inverse head and shoulders. So you can see here that we have the left, the head, and the right, and we've just broken back through. And all of this happened kind of in this little demandy zone. So it's makes sense. I mean, this is basically where you would expect, generally speaking, Bitcoin to find some strength. And a lot of that has to do with the current breakout that we saw the other day. Where are the sellers most likely for Bitcoin? Somewhere between that 29,500 to 30,000. So I think a lot of people will be trying to get it there. And then around here is probably where you're going to start seeing the selling. But that's not all. There's so much more to discuss because the markets are coming into the jobs numbers. And we've just seen the reaction to a weak jobs number. ADP, non-farm employment change, tends not to actually do that much to markets. So if it didn't do that much, what could the real number do? If it comes in weak, the market is going to think it's a sugar rush. And clearly that's what we've just seen today. So watch out for this number, 8:30 a.m. New York time, obviously on Friday morning. Thursday is just going to do what it's going to do, but there's some key levels for us to be watching. If you enjoyed today's video, then make sure to subscribe and of course smash that like button, hit the alert button as well. It does help us out. And thank you so much for watching as usual. Bye for now.